All right, let's jump right in. We're going to break down a really powerful but actually pretty simple option strategy today. It's built for one very specific scenario. You are absolutely convinced a stock is going down for the long haul and you want to act on it without losing sleep at night. So just imagine this for a second. You've done your homework, you've run the numbers, and you're thinking, this company is way overvalued. And we're not talking about a short-term dip. We're talking about a slow, steady decline over the next year, maybe even two. That's a serious conviction, and you need a serious tool to match it.
Now, the usual ways people play this have they have some really big, scary flaws. You could short the stock, right? But if you're wrong, your risk is literally unlimited. That's a nightmare scenario for any trader. Okay, so what about buying short-term puts? The problem there is you're in this frantic race against the clock. That's time decay, or theta, just eating away at your option's value every single day. You could be totally right about where the stock is headed and still lose all your money just because your timing was a little off.
So this brings us to the big problem. If you've got a long-term bearish view, you need a long-term strategy to go with it. You need something that gives your idea time to breathe, time to actually play out, and most importantly, you need a safety net. There just has to be a better way.
And you guessed it, there is. The solution all starts with understanding one specific kind of option. This is the main building block for our strategy, something called leaps.
So what in the world are leaps? Well, it's actually pretty simple. They're just options contracts, but with expiration dates that are way, way out in the future. Think a year or even 2 years from now. This long runway is the whole key. It massively slows down that pesky time decay and gives your long-term thesis the breathing room it desperately needs.
Okay, so we've got our problem, a long-term bearish conviction, and we've got our tool, the leap. Let's put these two pieces together and build our strategy.
The leap put strategy is honestly beautifully simple. All you're doing is buying a put option that expires a year or more from now. And specifically, you're looking at an in-the-money or at-the-money put. That just means its strike price is right around or even above where the stock is trading today. This sets you up perfectly to profit from a long, slow drop in the stock's price, all while using your capital in a really smart way.
So let's look at the profile here. Obviously, it's a bearish strategy. But the most important line on this whole chart is the risk profile. It is defined. Now, yes, the capital you need is going to be higher than buying a weekly option, for sure. But look at the complexity. It's low. This is about as straightforward as it gets for a directional bet.
All right, so that's the theory. We get what it is, but how do you actually, do it? How do you put this trade on? Let's walk through the actual mechanics.
Putting the strategy into action is really just 3 simple steps. First, and this is the most important part, you need that high-conviction, long-term bearish thesis. This isn't a random guess. Second, you pick your leap put. Going in the money or at the money gives you a higher delta, which is just a fancy way of saying the option's price will move more like the actual stock's price. And finally, step 3, you just buy the option. The price you pay, the premium, that's it. That's all you have at risk.
And this diagram, this shows you the magic of it all. Now, this is technically for a different strategy, a bear put spread, but the key principle on the downside is exactly the same for just buying a put. See that flat line at the bottom? As the stock price goes up, up, up against you, your loss hits a wall, a hard ceiling. It can't go any lower. That is the safety net that shorting a stock just doesn't have.
So this is the point I really want you to take home. The absolute total most you can ever lose on this trade is the premium you paid for that option. That's it, period. If you paid $500 for that leap put, $500 is your total risk. No margin calls, no waking up to a catastrophic loss. You know your downside the second you click buy.
But, of course, let's be real. No strategy is perfect. There are always risks and trade-offs. So let's wrap this up by taking a good, honest look at the whole picture.
Now, you'll hear a lot of smart folks like Christopher O give this advice, and it's fantastic advice. Don't make things too complicated. The more moving parts and weird legs you add to a trade, the more ways it can blow up in your face. It's a really good warning against trying to be too clever for your own good.
And that's exactly why this strategy is so great. It actually follows that advice by keeping things incredibly simple. This isn't some complex 10-legged spread. You are simply buying a put, one of the most basic trades there is, but you're just giving yourself a much longer timeline. It is a pure, simple, directional bet with its risk totally defined from the get-go.
So, what's the catch? Well, there are 3 big risks. First, the main one. If you're just playing wrong, and the stock goes up or even just stays flat, you can lose your entire premium. That's the price you pay for having defined risk. Second, this is not a set it and forget it kind of trade. If the story changes and your bearish view isn't valid anymore, you have to be disciplined and close the position. And finally, time decay is slow, but it never stops. It's still there, a constant little headwind, slowly chipping away at your option's value.
So who is this really for? Well, it's definitely not for day traders. This is for positional traders. It's for investors. It's for people who've done the deep dive research, they've formed a really strong thesis, and they want to use a little bit of leverage, but without the terrifying risk of shorting. And the most important ingredient, besides having a strong opinion, is patience. You have to have patience.
And really, it all boils down to this one question. When you have that kind of deep, long-term conviction, that feeling in your gut that a stock is headed down, is paying that premium, the price of admission, worth it to know that your risk is capped, to know that you have a safety net? For a lot of people, that peace of mind is worth every single penny.